welcome everybody. We got 45 minutes here to talk about the infrastructure that's required to make real-world assets work, which is something that we want to have. And I gave a talk earlier today over at the main event. Like, I could not possibly be more bullish about this ecosystem. And just to give you a sense, like, our estimate at EY is that by 2040, we will need to process on Ethereum roughly 450 million transactions a day, right? And the vast majority of those are going to be tokenized real-world assets. And we expect transaction volumes and values to grow at a compound annual rate of 28 to 35% for the next 20 years, right? You should be planning your career around the level of growth that is going to come in this market space. We have an incredible panel here of people today, and what we're going to do is we're going to have a process where each of us is going to spend a couple minutes introducing ourselves and kind of laying out a few key points and viewpoints. And then we're going to do a little bit of Q&A, including opening it up to the audience. And at the end of that time, you will have laughed, you will have cried, you will have learned, and it will have been an excellent experience. And we're going to start over at the end with Lewis. And Lewis is going to get us going, and then we'll come over this way, and I'll get the last word because I'm the moderator. So, Lewis.
Hi, folks. I'm Lewis Tuff, CTO at Brevan Howard Digital. Brevan Howard Digital, for those that aren't aware, is a digital-focused asset manager. We manage kind of $2.5 billion of assets, and really focused across the full remit of both illiquid and liquid strategies. So, venture, systematic, discretionary trading, as well as offering more crypto-native solutions around kind of treasury management. I think for us, with the institutional lens, some of the kind of key themes we're really looking at are, one, identity. I think the big hurdle and impediment for us and for others getting on chain is being able to really robustly understand who you're trading against, who you're seeing on the other side, who's in a liquidity pool, is that kind of toxic or not, how do you trace those funds back to a real-world identity. I think that's a big step and hurdle that we're looking at, and there's projects like Kunkel and others that we're leaning into to see, are they going to be the right solutions that will enable us to unlock the next wave of liquidity on chain. I think in terms of other infrastructure, we're really kind of partnering with companies like Athena and looking at different innovative ways that you can provide these structured financial products on chain. And for us, there's really kind of a lot of opportunity to also expose our own funds. So we have this kind of very wide spectrum of investment strategies. And so kind of tokenizing that fund, lowering the barrier to entry, being able to distribute that through brokerage platforms, through other fund managers, independent financial advisors. That's also been a kind of big focus for us. And so we have kind of projects like Libra that is really offering the gateway. So we kind of tokenized Brevan Howard Fund, tokenized BlackRock's Money Market Fund, and did that in partnership with Laser Digital. So it's kind of three things that we're focused on and is really interesting in this space.
Hey, Lewis, but before we go on, I just want to ask you a question. So in some of the pre-discussion, you talked about kind of like, we need all different kinds of data, but you specifically talked about mapping and geospatial. Have you looked at any of these like proof of location, proof of origin type of protocols?
Yeah, so we're looking at a number of these projects that are mapping data, like Hive Mapper and others. I think they're super fascinating, and there's all these kind of anecdotes of like hedge funds using kind of the Walmart parking data from satellite imagery. I think that's just kind of one example, but there's many, many ways that you can use drone technology, satellite imagery. There's now companies like Umbra that offer satellite imagery for $3,500, and it can see a soda can on the floor. That's the resolution of this image. And that is hugely powerful to then combine that with alternative data sets on chain and have kind of trusted oracles or alternative data providers. Speaking to the Truflation guys just yesterday, and they're offering a lot of these alternative data sets on chain at a very scalable and cost-efficient process.
Awesome, thank you. Martin.
Hey guys, Martin, founder of Mountain Protocol. We have a yield-bearing stablecoin backed by T-bills. It's the first regulated stablecoin, so it's permissionless on chain. And kind of like our view is, if crypto is going to grow past the speculation use case and the use case of providing an exit for emerging countries escaping their currencies, you need to be able to bring strategies into crypto that target not 30% returns, 40% returns, but actually strategies that target very low risk, but also 12% returns. The way those strategies look like in TradFi is usually you stack up a kind of a risk-free rate on top of some kind of premium that is brought in by some kind of risk that is taken by the principal. And that requires some kind of risk-free asset that can be composable across the whole DeFi ecosystem. So that is the product that we're bringing to the market. We feel like institutions are not going to come specifically for our product. They have access to T-bills already. Crypto institutions might, but traditional institutions are not going to come for that. They're going to come for a perp exchange that allows them to hedge soybeans on a very efficient way as compared to CME, but that perp exchange, in order to provide that competitive pricing, will require a product like Mountain. I think the challenges outside of the obvious kind of regulatory challenge and kind of like regulatory clarity, there's a lot of challenges specifically facing real-world assets. I think one, and hopefully we can comment around it, is pricing data. So real-world assets in TradFi, especially anything that is issued on a traditional world, has trading hours that are Monday through Friday. So they have an uptime of 25%, and then you have off-trading hours. So what happens when you have a Tesla stock on an Aave contract and suddenly Tesla underperforms on the market? How do you liquidate that? So I think there's a lot of challenges to be still solved. I think infrastructure is very interesting, but in order to bring these real-world assets on chain, we still need to solve some of those questions around how we integrate both, so institutions can come in and do what they're doing today, but in a more efficient way on chain.
Is there a special role for institutions like DTCC or Euroclear or others that have access to, they have preferential access, or they are considered a source of truth in the system? Do we kind of need their permission to make this work?
So I'm not going to talk about licensing because I'm not the expert. I think hopefully we can do it without them, because I think having a monopoly of power and some kind of data is going to make us move a lot slower. I think the solution is going to be market-derived, whereby centralized players or players like Brevan Howard that have a foot on TradFi and a foot on crypto can essentially hedge that Tesla stock and essentially allow for that Tesla stock to be liquidated on chain. So I think the solution should be more creative than depending on these types of institutions to change their ecosystems to work 24/7. I think if we wait for that, we're going to be waiting for a long time.
We probably are. Well, I always have a joke. I say there's no such thing as permissioned innovation, right? If you need to ask, the answer is always going to be, we'll form a committee and get back to you, which is the same as no, by the way. It's the polite way of saying no. Niklas, talk to us about Chronicle and the infrastructure that you guys are building.
Yeah, would love to. So my name is Niklas Kunkel. I'm the founder of Chronicle Protocol. Chronicle is the first oracle on Ethereum. So we launched in June of 2017, which makes us one of the oldest, most battle-tested protocols in all of kind of crypto, going on 7 years now. We secure just over $8 billion in assets. We secure a lot of the DeFi heavyweights like Maker and most recently Morpho. And I think that oracles are going to kind of play a key part in scaling tokenized assets. For context here, right? What does an oracle do? I think people have this misconception that an oracle just kind of gives you the price of something, because that's kind of the implementation of how they've historically been used in DeFi. But really the problem that oracles solve is that blockchains are kind of like black boxes. They don't really have any way to get information from outside of the chain, at least not in a native way. And so oracles kind of solve this problem, right? And so a good way of thinking about it is like if you put your phone in airplane mode, how useless does your phone become when the applications aren't able to send and receive data? It's the ability to send and receive data that gives the applications on your phone the rich utility, right, that you want. And it's going to be the same for tokenized assets. And so the role that oracles play is going to change and really transform into like this interoperability layer between off-chain traditional finance and on-chain.
Awesome, thank you. I want to ask you a question that I ask everybody who's into oracles. What do you do when there's really only one source of information, right? And that is in the hands of a proprietary entity. As I always ask people, like, there is only one company that knows where your FedEx package is, and it's FedEx, right? So how do you build the trust that the data coming from an enterprise is actually trustworthy?
Well, I mean, garbage in, garbage out, right? The oracle can only be as strong as the source of the data, right? And you mentioned kind of this like federalist kind of methodology, right? Where if data is available, multiple sources, right? You can kind of query all of them and model them in a certain way to get some kind of data integrity guarantees. But you're right. If there's only one source of data, I mean, there's one source of data. That's your source of truth.
Right, but let's say I have a contract with you. I pay upon delivery, payment upon delivery, right? Mm-hmm. So if I corrupt the oracle or I cause, I can force payment by falsifying delivery, for example. So should companies that are the sole source of data, should they have to put up a bond in order to have a trustworthy oracle, for example?
Sure. So there's definitely like a rich band of mechanism designed, right, that you can do here, right? Staking assets is certainly one of them, right? Putting up some kind of bond. I think a lot of that will really get externalized to the fringes, and oracles themselves will just solve around the data delivery problem, right? And ensuring data availability, right? And censorship resistance. Because the integrity problem is going to be really unique to each. Well, we're talking today like in the context of tokenized assets, right? And so those things are really bespoke, right? And so those are going to be unique to what is this asset, what is this data, what is the relationship, what is someone trying to do, what are the negative externalities if something goes wrong here, right? And I don't think it really makes sense to like shove that in the core part of the data layer.
Okay, thank you. Stefan, talk to us about Gnosis, please.
Yeah, thanks for coming. I'm Stefan, co-founder and CTO of Gnosis. I started the Safe project with Gnosis that some of you might know or use. Gnosis right now, we are focused on effectively building a competitor to neobanks. So those that have been following us for a long time know we've been building a lot of different things, really ranging from like core Ethereum infrastructure, node development, to dApp development, to account abstraction, kind of everything. And more recently we shifted also our focus on wallet creation. So we are creating that we call the Homer Simpson wallet, so a wallet that anyone can use, where we try to bundle all the services that we've been building into one nice user experience that literally anyone should be able to use. So that's where we see the big opportunity. And one part of the strategy is what we've been building with Gnosis Pay. Gnosis Pay, some of you might heard of. Most people associated with the card. Oh, great. We have a customer right here. It's great that you have the card because I forgot to bring my card. But yeah, this is the Gnosis Pay card that you can currently, actually we're distributing it here for free.
Does that come with money on it?
So again?
It's a free card that comes with money on it? It's like an airdrop?
Soon, well, let's go into details. But for now, it's just a card. I recommend everyone to get this card. What is different from this card to every other card is it actually allows you to pay with crypto that you have in your self-custodial wallet. And the card is only one mechanism, kind of. What we are doing is we're building all kind of bridges that allow you to transact in the traditional transactional systems, like SEPA, like Visa, MasterCard, you name it. That is the goal. So we make it kind of frictionless for users to operate in both worlds. So it's for them basically indistinguishable. And while doing this, we also face a lot of challenges, speaking about real-world assets and what general challenges are. So integrating to Visa is great, and Visa allows us to have crypto accepted almost anywhere. But obviously, as we're building on blockchain first, there are still some shortcomings which touch also privacy. So right now, if you pay with your card, transactions are settled on chain, so they are visible. Of course, your name is not necessarily attached to it, but it's visible. And at some point, someone pointed this out on Twitter, and then Visa, who is a big supporter and official partner of ours, and reached out to us like, oh, this is not private. We didn't know that. And then we had to explain them like how the system actually works. But also pointed obviously out the flaw, like, okay, if we really want to scale to the user base that Revolut has, then it matters that people understand that what they do is not public. And if you go to McDonald's and buy a Big Mac, people will not be able to understand that you just did that or other things. And so privacy is, I think, to some degree it's solved. A lot of people have doing great work, including yourself. But we also have to solve it on a large scale, like to really allow everyone to benefit from private transactions. So I think that's on the technical side still one of the things that we have to improve on. I think I'm not worried about the other aspects in terms of user experience or scalability. I think for me those are basically solved, but that's a very important one. And then I think on the other part is on the regulatory side. So I just had a discussion today with our team. We are supporting like a real-world asset, like multiple real-world asset teams. One of them is backed finance. Been issuing, they're operating on Gnosis chain for a long time. But until today, it's a challenge for us to provide liquidity for those assets, for everyone to actually be able to trade those. And that falls then back to the question of how is this actually regulated? How can you offer this in a way that we can actually promote it to everyone? And that is still not 100% obvious to everyone. And there's a lot of, let's say, nuances and uncertainties that then ultimately lead to a situation where maybe there is no liquidity for those assets. And then I think that's also one of the main problems. Like people I think want real world assets, but it's really difficult right now still to actually even give people access to it. Like right now I personally hold Coinbase stock since like 2 years. On Gnosis chain, and thankfully I did this because Coinbase went up. But the way how I got to this Coinbase stock was very convoluted. Like I had to register, go through multiple KYC, like do all kind of KYT checks on my wallet. It was really a very like not user-friendly process, and we have to get to a place obviously where everyone can just buy those as easily as possible. There will be probably infrastructure needed that makes it more seamless, but yeah, this is right now for me like not yet a fully solved problem.
So that's interesting you say that you feel like scalability is solved, but user experience isn't. So you're comfortable that 30% a year transaction volume growth, no problem for 10 or 20 years?
Right. Actually, I would even say user experience to some extent is also solved, at least from technical side, it's solved. Like I think we have account abstraction and whatnot. We just have to put those things together in a way that is compliant with regulatory requirements. But I don't see, from a technical perspective, that there's any limitation right now.
Excellent. All right. And now it's my turn. So I'm Paul Brody. In my day job, I am the global blockchain leader at EY, Ernst & Young, big, giant, global accounting and professional services firm. You will not be surprised to hear me recommend that you all need an audit. And you should get it from us or somebody like us. And secondly, in my nighttime job, I'm the chairman of the Enterprise Ethereum Alliance, and I'm going to shamelessly plug 2 things here. Number 1, please join the EEA. We represent business users around the world, and we have an industry day, Bangkok, the 11th of November, right before DevCon. And then secondly, I wrote a book. It's called Ethereum for Business. It's the most important self-help book you can give to somebody who still believes that permissioned blockchains are a good idea. If you care about them, give them this book and help them see the error of their ways. Kind of a couple of thoughts about the infrastructure that we need. I think there's really 3, and some of the other folks, the challenge of going last is that everybody else has already said like the good stuff before you. But I think number 1 for us at the top of the list is the infrastructure required to build trust. And there's multiple parts of this. Part of this is you really do, like if you go back to that whole like old saw, trust but verify, right? One of the things that we're missing in this market is verify, right? If you transact solely in crypto, everything you need to know is on chain. The minute you start transacting in real world assets, all the important stuff is in the real world. And somebody else has to tell you what it is, and you have to be able to trust that. And that includes, there's oracles, but you also need things like audits, attestations, SOC reports. This is super exciting stuff, but it's really, really necessary. Secondly, and it's kind of related to the institution of building trust, our regulators need more capacity. And I want to relay a great story. I don't know if it's a great story, but I thought it was interesting. Yesterday, I got to spend the afternoon with a bunch of folks from the European Commission, which was awesome. These are the people who helped draft the MiCA legislation. And I started by just telling them how much I love and appreciate them, because they've really set a benchmark in Europe that we are a long way from matching in the United States. Like, they deserve, Americans sometimes are like, oh, America innovates, Europe regulates. This is a wonderful example of regulation clearing a path for an enormous amount of innovation and investment. And by the way, the people I spoke to in the European Commission, super bullish on Ethereum, super bullish on public blockchains. Like, I left that meeting on an absolute high. But the one kind of interesting red flag that they raised was that they really have a serious bandwidth constraint. Regulators, there are not enough people in these regulatory organizations that understand blockchain. Right? We need, as a public service, more people like you to go into the regulatory environment, not for the purpose of regulatory capture, but for the purpose of education, of skills, of knowledge, because if you have education, if you have skills and knowledge, if you understand the blockchain ecosystem, you can make a huge difference in explaining things in a way that's understandable and comprehensible, and getting regulation that's implementable in a feasible and thoughtful way. Secondly, I am incredibly passionate about privacy, right? Fundamentally, whether it's tracking your Big Mac or concealing your trading strategy, we need privacy at scale. This is something that EY has invested heavily in. We built a Nightfall, which is an Ethereum L2. It's enterprise only. And one of the things we spend a lot of time doing is educating regulators about the difference between anonymity and privacy, right? Criminals want anonymous payments. Enterprises and business users want private payments, and there is a difference between that. And then lastly, you nailed it so well, simplicity is essential, and it's essential at every level. We often talk about consumers when we talk about simplicity, but it's not just consumers. Enterprise IT departments, bank IT departments are different today than they were 20 years ago. Bank IT departments and enterprise IT departments 20 years ago or 30 years ago, they had lots of technical developers. All of those people, they work at product companies now, right? What's inside the enterprise today are people who manage vendors and people who plug in APIs. And the products that you make, even at the enterprise level, need to be ridiculously simple, right? And I look at Shopify as my favorite example. E-commerce is not less complicated than it was before, but they made it ridiculously easy to set up a storefront online. That is the level of simplicity that we need. Like, anybody needs to be able to do it, even in an enterprise environment. So those are kind of some of my key thoughts in terms of institutions. Some of it's technical, some of it's like people institution building the sort of regulatory layer zero. So I think everybody's gotten a little bit of a say. And what I'd like to do now is I want to pose some questions to the panel. Right, and one of the ones I want to talk to the panel about here, and you can pick, whoever wants to answer, let me know. But I want to ask you about security, because I spent many years at IBM, and at IBM we would have this saying like, if it's got code, it's got bugs, and bugs are just security problems, right? And all of this infrastructure is built on code. It's fragile, and it keeps breaking. Like, what systematically can we or should we be doing to reduce the level of cyber risk? Because if we cannot build trust, if we cannot reasonably expect that typical contracts are not going to be easily hacked, it's going to be really hard to get scale.
I would argue actually for real-world assets, I'm not that concerned, because the infrastructure that you probably find the most, let's say, critical, let's say the tokens that are on chain, for example, I think they can be pretty simplistic. So if I look at the code, of most of the real-world asset providers on-chain. That is nothing that I would consider like too sophisticated. Plus, they have already all kind of like safeguarding measures in place to potentially interfere if something goes wrong. I think in the worst case, you can even go to a level where, like, if something is more decentralized, then I think usually there is still like some sort of agency within the community that allows to trigger a certain event to undo things. And I was actually, I had this case myself where I effectively lost access to tokens, and it was possible through a governance vote to regain access to those. And I think that was a good example for how in a decentralized environment you can also kind of go away from this idea of like code is law and interfere if necessary. So I think, in my opinion, that's not for me the most concerning thing.
I have a slightly different perspective. I think that actually the kind of back doors that you're describing make me extremely anxious and paranoid. I mean, if there's a way of overriding, of blocking, of freezing assets, then three-letter agencies will be knocking on your door and forcing you to enforce it, right? And so then you get into this situation where it's like, who are you protecting here? I think that for us, we think a lot about security, managing multiple billions of assets of client funds. We cannot put any of those at risk. And every protocol, every contract call we make, every custodian, every exchange has to go through heightened due diligence on an ongoing basis. And I think to your original question, like, how do we push this forward? I think some exciting things that are emerging are like the SEAL Alliance. This is kind of a group of the best security engineers in the space, all of a shared vision and mission to really provide standardization, to provide kind of 24/7 hotline in a reactive manner, and really to help actually do proactive work with venture funds, investment firms, which most of them, Paul, to your point, have very small technical teams. Like, I'm surprised the number of firms that I speak to that have 0 security engineers, quite literally, or they have 1, and that person is just a vendor manager. They're not really doing any engineering at this point. So for me, yeah, it's extremely important, something that we think about a lot and keeps me up at night. And I don't think it's a solved problem. I think actually we need standardization, we need attestation, and we need to actually have a benchmark and watermark for like what does good look like on chain in terms of contract deployment, code, architecture, which I don't think we're there yet. And so you're seeing kind of this like long tail of quote unquote auditors, right? White hats coming and emerging. I mean, there's no quality control around that. And so you've got protocols that maybe have had 3 different auditors, but then they get hacked for hundreds of million. So something went wrong there. And I think actually it's a growth problem, and it's people kind of capitalizing on the massive demand for robust security solutions in audit, and there's not enough quality out in the market today.
So I do want to just briefly get on my hobby horse as somebody who works at an audit firm. We really need to stop calling these smart contract audits. They are not audits, right? And they do not come with the kind of regulatory guarantee that an actual regulated auditor gives them. And it's interesting, we do what other people call audits, and we are specifically prohibited from calling them audits. We are allowed to call them smart contract reviews. And we do them, and even when we do them, you are not allowed to slap an EY logo on it and say, EY reviewed our contract and they say it's fine, right? That is not allowed. And so it's a very interesting requirement because it separates the people who honestly want a better contract from the people who just want to slap a logo on the thing and say it was reviewed and it's audited. It's not, and it's going to be hacked easily.
So the security topic is very near and dear to my heart. In a past life, I too worked at IBM on mainframes, if you can believe that.
No, you're too young.
And so my love for mission critical systems started there. So for those of you who don't know, even though you probably haven't heard of a mainframe since some movie in the 90s, they actually still today underpin a lot of the systems around you that you use every day. So every time you swipe your credit card, every time you make a flight reservation, every time you make a hotel reservation, even just the entire flight tracking system, flight scheduling, crew scheduling, all of this is going through mainframes. And so, if there was ever a bug in mainframes, right, the world would literally collapse around us. And so, that's the reason why these systems that we built in the 50s, 60s, and 70s still exist today, because we've really perfected them over that course of time, and that's why what we consider a relic is still around, right? But moving on here, right? I mean, when you think about oracles, they're kind of the Achilles heel of a protocol. I mean, think of a DeFi protocol, right? In how oracles are used today, right? You have some kind of lender, and it is pricing collateral based off an oracle, right? It is determining when a position gets liquidated, or how much a borrower can borrow against a set amount of collateral. So if your oracle misreports the value, right, a lending protocol can easily just become insolvent instantaneously, right? And we've seen this happen, right, in DeFi with all of these hacks where hundreds of millions, right, of crypto, right, cumulatively billions, right, get stolen. So it's incredibly important, right, when selecting an oracle, right, that you do your real due diligence, right, and not select the cheapest one, or the one that can deliver yesterday because you're in a rush to launch next week, right? You really are tying your destiny to this oracle. So you want to be absolutely sure, right, that they are taking that responsibility absolutely seriously, right? And so fortunately, we work in an industry that's all about cryptography, right? And so while cryptography is not the end-all, be-all to everything, right, there's definitely mechanisms that we can design around ensuring that data is not tampered with, right? So you mentioned, right, that data is siloed at a source, right? If we can get the source to sign the data, right, then we can always verify on-chain cryptographically that that data came from that source and has not been tampered with. And while there are definitely other considerations for security, when it comes to data integrity, I think that's the main concern, and as long as we build mechanisms centered around cryptography, we'll be in a good place.
Excellent. Martin, I know you want to talk. Before Martin adds a comment, I'm just saying, prepare your questions. In a couple minutes, we're going to have questions from the audience.
Yeah, two comments. I think the first one has to do with how do you build resilience on code in general. I think open code and open source, which crypto mostly is, yes, you audit prior, or you review contracts prior to deployment, but the actual kind of like qualification of the product as being safe actually happens as like the area under the curve of like TVL and time, right? And that's why mainframes still exist, right? They've managed millions of transactions per minute for years, and that's why we're nervous about updating them. I think smart contracts have the advantage of, because you can initiate with early use cases, usually driven by speculation, a lot of what we have today built in DeFi, it can be considered very, very safe. I think the second point that I wanted to make, going to kind of freezing and blocking, I think in the industry, we believe that not having a freeze and block of an asset makes it safe. I think, there are some assets that cannot be frozen and blocked. ETH, BTC, there are some. But there are many assets, and I would say for real-world assets, mostly all of them, that they can be enforced at the smart contract level, or they can be enforced at a lower level if you don't allow the smart contract level to enforce it. And I think in today's kind of compliance world where financial sanctions are a reality, and that kind of we live with this decision, is it's very hard to actually not have a smart contract that allows for blacklisting of addresses, because the answer after Hamas buys a couple million of your asset is, okay, if you cannot freeze Hamas, then you have to freeze everything. Or the broker that you're working freezes everything and you have a bank run on your product. So the freeze will happen if it can happen. It will just happen at a lower level in the stack. And I think that's something that it's not only smart contract, you have to see at the the full IOU chain that you have between the token and the actual underlying asset.
So, Martin, your comment actually brings me to something I've been wanting to ask, which is traditional financial institutions, they have built over the years a bunch of infrastructure that are designed to deal with market panics, right? There are circuit breakers, nights, weekends, right? If you go back to the story of like the stock market crash in like 1929, I think in the course of one night, JP Morgan was sort of roped into and agreed to bail out like half the banks on Wall Street, right? In a 24/7 market, there is no break for the market participants to get together and deal with it. So my question, just generally for the audience, but start with you, Martin, is what are the pieces of infrastructure or process from traditional marketplaces that we should seriously consider figuring out how to adopt and implement in a sort of truly blockchain native way, but take into account things like circuit breakers, panics, containing the risk of contagion, things like that?
I think I have some ideas there, but the first thing is how do you prevent these things from happening? I think in general, when you have a panic like that, it is because risk built in the system, and risk is slow to build, but very fast to unwind. Usually, risk builds in the system because there is someone taking risk because someone else allowed them to take that risk and taking it on behalf of someone else. So a bank is a very good example. Depositors deposit money on a bank. The bank can take risky, and we saw that with 2008. They were selling mortgage-backed credit default swaps, and those credit default swaps were rated by some other agency for AAA, and because they were allowed, they did it, and then smart money came in and started taking the other side of that bet and almost brought down those banks. So I think the first thing is how do you avoid and empower the actual liquidity provider or the actual depositor to take that risk. So I think that's how you start preventing it. And the transparency of blockchains, I wouldn't say solves it because it never does, but it allows a lot more people to figure this out a lot earlier. I think in terms of what you do when these things actually build up, I like what Angle Protocol is doing with Transmuter. They have a kind of like one-to-one AMM, but whenever they see that there's a very directional flow, which tells them, hey, there's a DPEG here, they socialize the losses. So instead of creating a bank run where everyone gets 100 and the last person gets 0, they socialize the losses so that you essentially can make a choice whether you want to continue taking that loss or not, and essentially stop the bank run kind of a lot earlier. So I think that's a very good idea that we're going to see a lot more.
Other answers to that question?
From a pure technical perspective, there's quite a lot of companies that became insanely good at understanding the mempool and what will happen if the transactions are actually applied. So they actually are able to foresee a lot of the attacks already. And one of them is block native. I think they've been really exceptional in understanding how those can play out. And that's kind of course, the first requirement in order to actually implement something like a circuit breaker. And I mean, right now, I'm personally also in a few of those, let's say, control agencies to potentially interfere in certain protocols. And that's definitely not scalable, nor like you can act on time. So I think the next step is kind of replacing, unfortunately, a lot of the multisigs with something that is probably better to react faster using this intelligence that companies have been creating over the last months and years to react in such cases. Of course, you have to be always very careful that this cannot be misused, but I think at least in terms of what has been created from technology point of view, there are a lot of interesting solutions right now which can improve the situation quite a bit.
Excellent. So we have a few minutes for questions from the audience if we have questions from the audience. Anybody raise your hand? Yes, sir, at the back. You shout it out and I'll repeat it. Oh, we have a microphone. How awesome.
So my question is for Stefan. Okay, first of all, vielen Dank für Gnosis, echt klasse. It's great work, we love it. The issue with RWAs is, so we don't have an established standard like ERC20s or 721s, okay? So there are all these institutions like EthCC is different and Buffin is different, we have SPK, and then they require you to report them that you're gonna transfer this security from this person to that person, and then you have to have like a broker-dealer, a transfer agent, all kinds of stuff. Do you have any kind of plans to integrate with all these institutions to make this transfer? So unlike an ETH, where you just like take it from the owner and send it to the other guy, it's like simple. Do you have any plans to integrate it into your wallets?
So if I look at actual real-world assets issued today, most of them are actually just ERC20 tokens. And thankfully, some of them, they purposefully decided against integrating any of them. So they are fully DeFi compatible and you're not, you know, there's little interference. And honestly, if I look at one of the largest securities on chain, USDC, if I look at the implementation of it, for me it's also kind of like if I look at they have the function to block assets, freeze assets, right? But the way it's implemented, it could always, like at least previously, could have been easily front-run by the person whose assets would have been frozen. So in fact, they have the function implemented, but de facto, the person who has the assets could just send the assets to another account just before Circle decides to actually block this account. That's just how it's implemented. You can look at it on chain. It's just
the new Gnosis service coming.
No,
soon.
No, just saying. Like I would say, like you can build all of these functionality in, but it's a matter like how it's implemented and how it's integrated. And of course, my expectation is also as things are maturing, there will be, let's say, more effective channels to interfere if something has to be done. Because in real-world assets, as we all know, ultimately, the token on-chain is just a representation, and the actual assets are held off-chain. So there's still like always an ultimate way to interfere. And so I foresee this right now. I could not say that we're talking to the SEC or anyone to kind of streamline this process, but...
So maybe a UTXO model?
That's good. Well, I guess that is one way to deal with this, but yeah, it's of course not compatible really with the ERC20 tokens.
Awesome. Other questions? All right. I've got a question if we don't have any others. I want to ask about automated enforcement. So one of I get invited to conversations with regulators all the time, and sometimes there'll be somebody in the room like, oh, we can just put the compliance rules in the smart contract, right? But the problem with that is you're going to make the smart contract very complex and very hackable, and how are you going to deal with the compliance rules for 100 different countries? Is automated kind of enforcement or compliance, is that a pipe dream? Do we need to stop talking about that because it's fundamentally dishonest? I guess I sort of answered I expressed my opinion in the question.
I agree with you. Like it doesn't make sense to have, first of all, the way how we talk to regulators also trying to, as you said, education is very important. The regulator has a goal, which is customer protection. And I think our task is to show the regulator that we have better means of customer protection through technology. And that is, of course, always evolving. To give an example, right now, everyone has to go through KYC again and again and again. Now we have multiple companies that allow you to generate like ZK proofs around your passport, for example, to reveal only the data that the other party actually needs. Like, yeah, you're from Germany, yeah, you're above 18 years old, but you don't have to reveal like the city you're from or like your actual age. So I think there's many ways we can improve this. And because it's evolving in itself, I would never put this directly into a smart contract, but rather like this is where we have to push the boundaries.
Awesome, thank you. I think Lewis had that.
I think actually oracles are the answer here, right? So you offload kind of the rule set, which is fully extensible, and within the contract itself, you just need the kind of callback and hooks to be able to then run basically from the TradFi world like pre-trade risk checks on transaction simulation before it actually hits the chain. And I think that's the way we can kind of move forwards, and there's some emerging projects around that.
Awesome. So we have 1 minute, 18 seconds. Final round. This is the lightning round. Your final closing thoughts. You get the last word. We'll start with Lewis and move over here.
For me, what I'd love to see is a way for institutions to verify and prove identity on chain. So anyone who's solving that problem, please go and speak to me afterwards.
I'm excited to see a lot of the infrastructure that we've built, but with other types of assets. Particularly perpetual exchanges with agricultural assets, oil, gold, and so on, and tap at emerging markets, right? Like the institutions, they have CME, they have very good access, but there's a lot of places that can use the infrastructure that exists today, and essentially we can start conquering Normandy and conquer Europe from the easy place to access. And I think emerging markets are that Normandy.
I think everyone is underestimating how quickly tokenized assets are going to scale. I think within a few years, it's going to make non-tokenized asset DeFi look like a tiny speck of dust. And I think we have the perfect storm brewing with coming regulatory clarity in all of the major jurisdictions. Stefan, you mentioned, right, it's not a technology problem anymore. We really have, like, there's still some things on the fringe we need to figure out, but we have the capital markets to be able to build this stuff, and judging by all of you here, right, we have others who recognize, right, the value here. So I think it's going to go quite quickly, and very, very happy to be a part of it.
Stefan.
Yeah, I think we're at an inflection point. Right now, if you look at the market cap of real-world assets, excluding USDT and USDC, it's tiny, but I expect this to really explode in the next, maybe even couple of months, definitely years. There's few issues that have to be still solved, like small technical issues, like privacy on scale. If you're working on this, would love to talk to you. I think what the Tornado Cash guys did was great. It's unfortunate that because we were not able to offer solutions on a large scale, it was abused by a few, and that should change. I think the narrative would be very different if this technology would actually be used for us on a daily basis, and no one would ever question it.
Excellent. Two quick thoughts. Number one, for some of you, please think about your next career move is to work at a regulator, because they need your expertise. We need to solve the regulator bandwidth problem so that we can accelerate this industry. And number two, you guys have been an awesome audience. I didn't see anyone sleeping. Thank you.